bit earlier, my team covers everything from long only fixed income to long short to private credit, and we can really kind of navigate and within that space increase maybe structured credit here, senior bank loans or CLOs in other parts of the portfolio. And we have seen kind of we also try to understand a budget that we'd like to spend on private debt, but we really haven't hit that budget, kind of given some of the opportunities in the space that we're seeing. We just haven't been too excited about. One thing we have been doing in the space is focused on dislocation funds or delayed drawdown funds of allocating and committing to groups that we're saying will call down and draw the capital when a dislocation in the market hits, as opposed to funding them now and having them go put the money to work now. So in a way, it is kind of a lowering our allocation within private credit, but delaying it to a later point where they do see larger opportunities in the space, and then also saving us from ourselves and saying that, yeah, we promise you we'll give you money when the time hits, but then that never really happens. So just kind of a behavioral type approach to it as well.
I'm always curious, when you look at strategies like that, do they tend to charge fees based on when capital's committed or called? And then if it is called, how do you ensure alignment between the two parties?
Right, and that's a great question. A lot of our time in diligence is spending and understanding when they might call, what might trigger that, and the investment, the fees are basically on invested capital, right? And so that's I think that's for each of our groups that we're using in that space. It's uninvested, but it's a great question of trying to understand when and how they will pull down that capital, and understand if they're doing it for the right reasons. That we're starting to see groups actually take this model and what we think might abuse it, not have the full faith that they would follow that rule. So it's a good question, and big part of the diligence process. Yeah.
So switching gears, I think there's some recent news articles and discussions earlier about peer-to-peer lending. I would love to hear if anybody on the panel has experience with peer-to-peer lending, and if you view that this is something that might be in the fad category or something that is a little bit more of a sustainable model.
Yeah, I'll take a stab at that. I would say peer-to-peer lending, aside from maybe some exposure in our venture capital portfolio to the actual equity in the companies, we don't have any exposure on the credit side. I think if we were to, it would be more likely with I would think almost a kind of multi-sector credit hedge fund potentially, where they could leg into the space, gauge the liquidity, and potentially grow that over time. It's nothing that we have in our portfolio now.
Sorry, yeah.
Go ahead.
And the same here. We haven't done much, but it's actually become kind of an ongoing question when diligencing some of our current groups, particularly some of the stuff that we're seeing in structured credit, right? It doesn't sound like they're a big, the peer-to-peer lending and their securitizations aren't a big player in the space now, but can one day that become a competitor to some of the more traditional ABS and financing, consumer loans, auto loans, student loans. So right now we're making sure that our managers are familiar with some of the competitive risks that it can introduce into the market. But to the same points that you have, we haven't done anything.
I would just add to that, we don't do any peer-to-peer. We like loans to companies we can underwrite, do the credit work on. But there was a Bloomberg article about this morning. And basically, I forgot the details. I only read the first 2 paragraphs, but saying in these peer-to-peer lenders, guess what? They're not actually doing underwriting. Yeah. So that's why we would stay away from something like that. We need to underwrite it. We need to understand the risk we're taking for the reward that we'll get. And peer-to-peer and consumer lending just doesn't fit that. But equal to his answer, maybe it could be part of a broader fund, but not in our case where we have a separately managed account and relying on the good yield of these assets for our strategy.
Yeah.
Excellent. And Eric, I'd be curious to see, as you've had maybe more tourists come into your space on the private credit, have you heard from your managers that they're able to lax some of the underwriting because of the increased demand, or has that not come through?
Not really come through. We talk about it all the time. But let me put this in context. For Aflac, we run a separately managed account. And we have two mandates, one through Goldman Sachs, which actually has Antares running it, and one which we recently announced with NXT Capital. Separately managed account, credit guidelines that suit us. We have a credit team. They're not experts in this, but they review that, and an outsourcing team that reviews that. So we have keen insight into the market, into what's happening, but we don't want to relax credit standards, nor have our managers recommended that we do so. In the bank loan space, I think you're seeing that being a challenge. In the bank loan space, covenants are going out the window, not in the middle market loan space. But because it's a separately managed account, we have the ability to turn on the spigot, turn off the spigot. If NXT or Antares were to suggest to us the standards are getting lax, we probably won't like that. And we probably would just say we're going to hold off on future allocations and perhaps ride it out.